Hello and a warm welcome. You're watching Business at 9 with me, Jude Sananth. Let's start with some geopolitical action first. In fact, US Treasury Secretary Scott Bessent has announced that a deal to open the Strait of Hormuz could be struck as early as today or tomorrow. This while the Trump administration is projecting that that deal could in fact be struck soon. Tehran has said that it is focusing on talks with Oman for the moment. My colleague Sumita is here with more details.
That's right. We've heard President Donald Trump talk about a deal, a possible deal with the Iranian side. But now Treasury Secretary Scott Bessent said yesterday that a deal could be struck with Iran to reopen the Strait of Hormuz. Remember, President Donald Trump threatened the largest military campaign since World War II against the Iranians, Bessent said. And because of that, we are in talks with Iranians. The U.S. president, remember, he also claimed a couple of hours back that an agreement with Iran was imminent. However, Iran did not sort of agree to his claims. In fact, Trump also claimed that he agreed for talks with Iran following requests from allies and that he'd called off these planned strikes on Iran. These were very, very strong strikes that he had planned. And he also spoke about how the topic of denuclearization of Iran would be broached as well. So, of course, that is one side of the story. The other side of the story is that the Qatari side, Qatari Foreign Ministry has also said that efforts to resolve the US-Iran war are in very progressive stages. In fact, the spokesperson has said that coordination regarding the Strait of Hormuz must be with all regional allies, but not just with one or two countries. He said that at the moment, there is a focus on short-term resolution to the conflict, and that is the focus of the mediators as far as the conflict is concerned. In fact, he said that we are looking towards a diplomatic resolution as we are speaking right now. But what is the Iranian side on all of this? Well, Iran has said that it was focusing on talks with Oman over a temporary route through the Strait of Hormuz. In fact, this route could be a single corridor rather than two routes. And in fact, Iran also want that it will target U.S. vessels and that any U.S. warship may try to impose U.S. vessels in case any U.S. warship tries to impose a different route than the one that Tehran has allowed for ships. So, of course, how soon a deal will be struck with respect to the Strait of Hormuz and the reopening of the Strait of Hormuz, that remains to be seen. As of now, Qatar has confirmed that that talks are on with respect to that.
Well, like Sumita was mentioning there could be a fair bit of uncertainty in the West Asia region, but it's a party on Wall Street. The S&P 500 has hit a fresh all-time intraday high by gaining over 1%, while the Nasdaq Composite gained 1.6%. The Dow Jones Industrial Average climbed to a record high by 1.4%, led by a huge 6% rise in stocks of Caterpillar. Now, this comes after the Trump administration's optimism on a deal with Iran over the Strait of Hormuz. Meanwhile, let's take a look at how domestic markets fared even as the Nifty came under pressure and closed above the 24,600 mark. Mid-caps, of course, corrected, while small caps gained in trade. Now, metals was the lone sectoral gainer, while realty and oil and gas stocks also slipped. HDFC Bank and ICICI Bank were the top losers in the Nifty today, and my colleague Snehi is here for that market roundup.
Well, yes, it's been a tepid Tuesday on the street, given the kind of moves that we've seen in the market. Speaking of the Nifty, at one point of the trading day, the Nifty had even slipped below that 24,500 mark. But in the last few minutes of trade, we saw a little bit of an uptick coming in. The Nifty has managed to shut shop above the 24,600 mark. So a good 120, 150 point uptick coming in from the day's low on the Nifty. And to be precise, 24,615. Thereabouts is where we've shut shop. It's still a cut of about 0.6% or 160 points on the Nifty. Sensex, however, has done nominally better, 0.3% cut over there, 210 points lower for the Sensex. Nifty Bank was also under pressure by about 0.6%. The broader end of the market was a mixed story because while you had about a 0.5% cut coming in on the Nifty mid-cap, the Nifty small-cap index, although off the day's highest point, has managed to still shut shop in the green. That's the kind of move that we've seen, and the 2% uptick is something that we've seen on the India VIX as well. Lots of earnings reactions at play. Before we talk about that, let's take you through what the sectoral tilt has looked like. All sectors, barring the Nifty Metal and the Media Index, have shut shop in the red. The biggest losers were Realty, Oil and Gas, FMCG, IT, Nifty Bank, Finance, Auto and Defence. And Nifty Metal was the sole sectoral gainer in terms of the bigger indexes, and that was up by about 1%. Good move from something like a sale, up 5%. Hindustan Zinc, Hindalco, Nalco, Jindal Stainless, all of these stocks have done well. So that's the kind of move that we've seen from the metal index. Now talking about the broader end of the market, the advanced decline ratio was of course in the favour of the declines, with about 180 stocks in the red and about 315 stocks with about 180 stocks in the green, pardon me, and the remaining stocks from the Nifty 500 in the red. So that's the kind of tilt that we saw from the broader end. However, on the flip side, some good moves coming in from Aether Industries on the back of good Q1 earnings, 14% higher. KI Industries on the back of a solid Q1 did well. Graphite, CG Power, Saregama was an earnings candidate as well. So these were some of the top performers. But on the flip side, LIC on the back of that government OFS news worth 31,000 crore rupees was lower by about 8%. Giant Resources on the back of weak earnings was lower. CE Infosystems, UPL, Prestige, Oberoi, lots of news flow in all of these names, and that's the reason why some of these stocks were trading lower and causing pressure on the broader end. But all in all, it's been a weak day of Nifty expiry coming in for the market. Yes, we've seen a recovery from the day's low, but we've still ended with cuts of about 0.6% for the Nifty.
Well, that was Snehi with the markets, but meanwhile, the RBI's three-day monetary policy meet is expected to be underway, with the street largely expecting a hold on that repo rate of 5.25%, even as it also expects the RBI itself to maintain its neutral stance. But what investors will be watching out for is the governor's outlook in terms of inflation, crude prices, so on and so forth, including rupee weakness, and whether the RBI tweaks its inflation or growth outlook. My colleague Ankur is here with a poll on what to expect.
Yes, Monetary Policy Committee is likely to hold rates at 5.25% this time, and the expectation is that that stance will also be retained to neutral. Apart from that, the important thing to watch out for in this monetary policy will be the commentary which will come in for inflation, because if you look at the June numbers particularly, that has surpassed 4% mark. It does remain within the tolerance band of Reserve Bank of India, but yes, it has crossed 4%. But more importantly, the WPI data was also showing that it is inching towards 10% mark. So overall, the IIP growth numbers does support the growth numbers, which is at 7.3%. But if you see the crude prices, if you see rupee levels, which continues to be near 95, it will be interesting what will be the commentary of Reserve Bank of India governor. And more importantly, whether or not there is a tinkering in the growth forecast for Reserve Bank of India, and how does FY27 inflation trajectory looks for Reserve Bank of India, and especially the commentary which is expected on FCNRB deposits, because ET now had reported that it has crossed 2013 numbers, and it has now gone towards a $36 billion mark as on July 31.
Well, meanwhile, it's all set to be a super Wednesday tomorrow, even as we at ET Now keep a track of that all-important Monetary Policy Committee with a star panel of experts dissecting and discussing all decisions taken. So make sure you tune in then for a day's worth of coverage on which way the RBI goes with regard to its Monetary Policy Committee all day tomorrow. Moving on, SEBI has proposed a framework to allow depository receipts to be issued against units of listed REITs and InvITs. The move is aimed to enable trading of these instruments on overseas exchanges, thereby giving foreign investors another avenue to invest in Indian real estate and infrastructure trusts, this while helping attract global capital. We have Anurag Joshi with more details on the story.
Markets regulator Securities and Exchange Board of India has released a consultation paper on regulatory framework on issue of depository receipts. SEBI's proposal on the issues of depository receipts are against the units of REITs and publicly listed InvITs. The proposals are based on the recommendations of the hybrid advisory panel of SEBI and units of real estate investment trusts and InvITs denominated in INR and are listed on the stock exchanges in India. REIT and InvIT can invite subscriptions and allot units to foreign investors, and the DRs may be issued against the units of a REIT or publicly offered InvIT. The framework will enable REIT and InvITs to issue DRs in the permissible jurisdictions, and DRs are foreign currency denominated and issued in the permissible jurisdiction by a foreign depository backed by an Indian security deposited with a domestic custodian in India. The framework provides an additional investment option for foreign investors, and DRs will allow trading in foreign currencies on global exchanges, and it will also help attract foreign capital into the local capital markets. SEBI has sought public comments on the consultation paper by August 25.
Meanwhile, Bharti Airtel has reported an inline set of numbers for the first quarter of FY27. Revenue has seen a 5.7% jump on a quarter-on-quarter basis. This while PAT is also up by about 11.5%. My colleague Darshita gets us more details on these earnings.
Right, Bharti Airtel has come out with its results for Q1 FY27. It's a largely inline quarter with the revenue and EBITDA coming in what the street was estimating, while the margins remain largely stable. Now, starting off first with the financials, the revenue stood at 58,539 crore, which is up 6% on a sequential basis, and the EBITDA has also rose by about 6% on a QOQ basis. Yes, we were penciling in 3% of the growth, but 6% is ahead of what we were estimating. The profit has also came at 8,167 crore, which was slightly below to what the street was estimating, but it is still up 11.5% on a sequential basis. Now, the biggest positive, however, was the ARPU, which came in at 264 rupee for this particular quarter versus the last quarter it was 257 rupee. Now, the important point to note here is that 80 now poll was 260 rupees, so it is up by 1.5% versus the estimates. And this also indicates that Airtel continued to earn more from each customer through tariff hikes and premiumization. Now, looking at the business segments, the India business remained healthy with the revenue growing about 3.9% on a QOQ basis versus we were penciling in 2.5% of the growth from India business. So yes, it has come ahead of what we were estimating, while the Africa business stood at about even stronger 9.6% of the growth coming in here, providing an additional boost to the overall performance. So yes, overall it was an inline set of results coming in, but the ARPU beat was better than expected. The revenue and EBITDA and strong Africa business growth were the key positives to watch, and we will listen to the con call which is happening tomorrow.
On to more earnings action next. Nykaa has reported a strong first quarter with profits witnessing a 29% jump year-on-year, even as revenue stands at about 2,782 crore rupees. In fact, Nykaa is expected to acquire 51% stake in Amino Wellness for around 32 crore rupees. Meanwhile, Marico has also reported its earnings for the first quarter of FY27. A 25% surge has been reported in profit at about 639 crore rupees. Revenue is up by about 22.9% as well to 3,957 crore rupees. Meanwhile, EBITDA has seen a 25% rise at about 819 crore rupees, while margins are at about 20.7%. Moving on then, the non-retail portion witnessing a full subscription on day one of the LIC offer for sale. Government sources say it will exercise its green shoe option to sell over 4% in terms of that stake itself. My colleague Prakash is here with more details.
Well, the government has decided to divest an additional 4% stake in LIC. Of course, you are aware of the fact that LIC is one company that the government is looking at to achieve its disinvestment target, which has been set for the financial year 2027. And therefore, it has decided to divest an additional 4% stake in LIC. In fact, the DIPAM secretary has mentioned that the offer for sale in LIC received an overwhelming response from institutional investors and was oversubscribed 3.32 times its base size. Along with that, he has also mentioned that the due to enthusiastic participation from investors, which reflects that investors reflects that there is robust investor confidence and depth in the India's capital markets, and therefore the government has decided to divest an additional 4% stake in LIC. The retail investors will get an opportunity to bid tomorrow. In fact, the government is expected to raise around rupees 31,000 crore by divesting a total 6.5% stake in the company, helping it achieve its FY27 disinvestment target of rupees 80,000 crore. The DIPAM secretary has also informed that the LIC stake sale through the OFS will help the company meet the minimum public shareholding norms prescribed under SEBI guidelines, which is required to achieve 25% minimum public shareholding requirement by May 2032. A very significant development at this point in time. You are aware of the fact that the government has adopted a minority stake sale in public sector enterprises to achieve its disinvestment target, which has been set for financial year 2027. And therefore, a very significant development at this point in time. Back to you.
Meanwhile, there's courtroom action in the insurance space. The Supreme Court has extended the mandatory third-party insurance to 4 years for cars and 6 years for two-wheelers, respectively, as per the observations of the top court. Despite this direction being issued exactly 8 years ago, the court observed that several vehicles remain uninsured. My colleague Anurag Shah joins us with more details pertaining to the Supreme Court's directions.
Major development in insurance space, motor insurance space, and in auto sector, where Supreme Court has extended mandatory third-party insurance coverage for new vehicles, new cars to 4 years and new two-wheelers to 6 years. Other than that, Supreme Court has also suggested to deny fuel to uninsured vehicle at petrol pump, has directed MORTH, Ministry and Road Transport, to with the help of technology to check uninsured vehicle through automatic cameras to check uninsured vehicle running on highways, because Supreme Court is of view that after 8 years, when the order was passed in year 2018, where Supreme Court mandated 3 years for new cars, mandatory third-party insurance, and 5 years for two-wheelers. After 8 years also, 56% vehicle running on roads are uninsured, and after accident through uninsured vehicle, victims have to run from pillar to post. So Supreme Court has directed State Transport Department, MORTH, to use technology to detect uninsured vehicle, to send e-challans to vehicle owners of uninsured vehicle, and to reduce the number of uninsured vehicles. So this is a positive development for insurance companies, but negative for auto sector, as new car, new two-wheeler, new private car will cost more, as insurance cost upfront will go up.
Moving on, Finance Minister Nirmala Sitharaman has introduced the Taxation and Other Laws Bill 2026 in the Lok Sabha to attract more foreign capital and promote domestic manufacturing. The bill proposes to make it easier for fund managers to relocate to India without the foreign fund being treated as doing business in India. Prakash gets us more details on this.
Well, the Taxation and Other Laws Amendment Bill 2026 has been introduced by the Finance Minister, and the government has proposed several amendments to the existing Act to make India an attractive investment destination. In fact, the bill will replace the ordinance promulgated on June 5 to provide exemption in LTCG tax to FPIs and FIs on their investment in government securities. Of course, the bill will replace the ordinance. In addition to that, several other amendments are also being made to the existing Act. The bill makes easier provisions to bring fund managers to India. A fund manager can now relocate to India without the foreign fund being treated as doing business in India. Of course, the proposal will apply to the entire India, including IFSC, so as to provide flexibility of location. In addition to that, certain provisions are being made to provide relief to investors in business trusts such as REITs and InvITs. In fact, the bill restores the exemption so that investors continue to receive their dividends tax-free even after the operating companies shift to the new regime. Of course, these provisions will provide impetus to the real estate sector going ahead. In addition to that, the bill also proposes clearer and simpler rules for data centers, which mandates to remove government requirements. That's an important development. Along with that, some amendments have also been proposed to the Income Tax Act to extend the tax exemption period for contract manufacturing undertaken with foreign companies. In fact, the tax benefit period is proposed to be extended from financial year 2031 to financial year 2041 in order to provide tax certainty. Some tax exemptions are being provided to foreign data miners as well. Along with that, there is a proposal to replace a safe harbor with the full exemption for component storage, a very significant development. In fact, the bill replaces the safe harbor with a state exemption so that income is simply not taxed for 15 years. So the bill has been introduced by the finance minister, which is expected to be cleared by the parliament during the ongoing session.
Well, moving on, the centre's PM Surya Ghar Muft Bijli Yojana continues to gather momentum, with the government adding 1 lakh beneficiary households every 6 days. Kuldeep speaks to the MNRE secretary about the scheme. Let's listen in.
First of all, many congratulations to you, and big milestone, over 50 lakh rooftop solar installations. Now with that, how hopeful you are of achieving the overall target of 1 CR by 31st March 2027?
Our PM Surya Ghar team here and the state governments are working to the best of their ability to achieve this 1 crore milestone by 31st March 2027. This 50 lakh milestone has come with a lot of hard work, and from the days when we were adding about 1 lakh households every 45 days, we have come to a stage when we are adding 1 lakh households every 6 days. We are expecting this pace to even gather much better pace, and in the days to come, we would like this to happen, this 1 lakh household addition to happen in 4 to 5 days. And if that happens, then we would be will be on track to achieve this 1 crore household target.
Sir, with respect to states, which are the states that performed really well so far? I mean, UP, Maharashtra, these are the states that names are coming up. And which are the states where the performance was not adequate, and what steps you're planning to enhance performance in these states as well?
So states like UP, Gujarat, Maharashtra and Kerala have done outstandingly well in this particular scheme. There were some states which were not doing very well but have picked up pace. States like Andhra Pradesh, Odisha have picked up, Madhya Pradesh have picked up pace in the last couple of months. There were some states which didn't participate in full scale in the earlier days, states like West Bengal and Tamil Nadu. But we have seen that these states have shown a lot of interest, and we expect the installations to gather pace in these states. So some of these states like West Bengal, Tamil Nadu, Karnataka, Chhattisgarh, we expect installations to go up in the next couple of months.
Well, moving on, in some alarming aviation news, an Air India flight flying in from Phuket to New Delhi suffered a rapid loss of 300 feet, thereby injuring crew and passengers when that incident is said to have taken place. In fact, the DGCA said that it was a transient technical fault that caused the rapid descent of the airline, and that precautionary checks for all passengers who landed in New Delhi had taken place after the incident. But scary times indeed for those passengers, 300 of them traveling on that flight. Meanwhile, Century Ply has announced what it calls India's first comprehensive plywood warranty, branded as Total Cover, aimed at changing how warranties work in the premium plywood segment. Unlike conventional warranties that typically replace only the plywood, Total Cover promises to reimburse the entire furniture from a covered defect. This includes not just the plywood, but also laminates or veneers, adhesives, labor and transportation costs. The warranty is available on Club Prime and Architect Ply products and it also remains valid for 10 years from the date of purchase. Customers need to register their purchase online within 90 days to receive a digital warranty certificate and can initiate claims through Century Ply's online portal or customer support, with every claim backed by a technical inspection. The company says the initiative stems from studying customer complaints over the last 2.5 years, which reveals that the biggest cost for homeowners was not replacing plywood but rebuilding the furniture around it. Let's listen in to Keshav Bajanka, Executive Director at Century Ply, who has more.
While for the last 2.5 years this research has been going on, this work has been going on, this thought process has been continuous, but the conviction that is behind this has been built over the last 4 decades. At every level, our chairman and our managing director have said that you will undercommit and overdeliver. And when you undercommit, your commitment should still be better than anything else that the customer is getting in the market today. That is the thought process with which this company originated. We call it, Nikita has already said, what do you call it? Project Sarvottam. Sarvada Sarvottam. So, Project Sarvottam, where our thought has been give the best, give the best, give the best. Elevate the experience. And what gives us this confidence?
And with that, it's a wrap on Business at 9. Thank you so much for watching, but we'll be back with more news and updates on the other side. So keep staying tuned to ET Now.